All right, so thank you for having us. We are just delighted to get acquainted with the Fallbrook Climate Action Campaign and to get to know a few of you here tonight. And I have come with Robert, my son. We have a family business for 25 years. We have specialized in sustainable and responsible investing. So we're gonna teach you a little bit about the basics of what that means. And we'll save plenty of time for question and answers afterwards. But before we get started, I'd like to kind of find out what you might be interested in knowing so that we can make sure to include that in our presentation as well. So if any of you had something that you wanted to learn tonight, just raise your hand and I'll call on you. Yes?
So one thing that we hear a lot about is divesting from fossil fuels.
Fossil fuel divestment.
Yeah.
Very good.
If we have money in mutual funds, we can't really pick and choose that very well.
That's right.
And also, to continue my question, there's the oil pipeline in South Dakota, I forget the name of it.
Keystone.
Keystone. And it goes underneath the river of an Indian reservation. And Wells Fargo is financing that.
That's right.
And there's been talked about we shouldn't have our money in Wells Fargo. But I do have bank accounts at Wells Fargo, so I don't know. It would be inconvenient to change.
Right.
I'm glad you mentioned that. I'll talk about that point. I'll elaborate more on that point in some of the slides there, because we do have some stories about that relate to Wells Fargo.
So since this is getting on video, I'm just going to repeat the question for the video. And that was number one, what we want to talk a little bit about fossil fuel divestment, and number two, what about the Keystone Pipeline and Wells Fargo? So we'll address both of those. Thank you. All right. Anything else? Yes.
I'm confused. There's a lot of socially responsible investment companies, and I'm really confused. Is the difference in the same as do you have all the same screens? Do you have different screens? This sort of thing. I noticed that I belong to the green, whatever it is, and I noticed you're in the green pages, and there's about 6 pages of socially responsible businesses. So if I were to choose one, fit me, I don't know how to go about it, so I don't know if we can get into that.
That's a great question. So the question is, what's the difference between all the different SRI, and we use SRI as the acronym for Sustainable and Responsible Investing. But what would be the difference between all the different advisors that may be perhaps listed in the Green America Green pages, which we're listed in there? And so that's a great question. So we'll make sure to talk about that.
Thank you.
Yes, you are welcome. And what was your name?
I'm Dorothy.
Dorothy. Thank you, Dorothy. Anybody else have anything they want us to talk about? Yes, I know you're Michael.
Yes. Do you do bonds and what are they rated?
Ah, bonds and what are bonds rated? Okay, we can talk about that.
Okay.
All right, these are some great questions.
Okay. Do you have mutual funds also?
We do have mutual funds. And we can talk a little bit about that.
Strictly green?
And we do specialize and exclusively do green portfolios. Yes, that's what we do. We're going to be talking all about that. Thank you. Bonds, don't let me forget.
Wells Fargo, don't let me forget.
Okay, you got it. What else? Anything else you want to make sure we talk about tonight? All right, if that's it, we'll just push forward. I'd also like to say thank you to Bill Manning, who used to be my neighbor down in Mount Helix. So we lived on the same street, and I have had that house down there for 20 years, although I recently moved up to La Costa. So now I live up a little bit closer to here, I guess you could say. But I love it here in Fallbrook. It's one of my favorite places to go bicycling. So I love to cycle, and it's really, really pretty up here. So let's go ahead and get started. Robert, I'll let you push the slides forward until it's your time to talk.
Sure.
How's that? So We are Blue Summit Wealth Management. Our offices are based in La Mesa, but we do serve clients all over. We're licensed in 22 states. I would say over half of our clients are out of state. We're very accustomed to working long distance. We manage over 90 million, close to 100 million in assets. And we also do comprehensive financial planning for our clients that need that as well. We collaborate with a lot of the national firms, some of the mutual fund companies and private money managers as well. We've listed just a few up here, like Pax and Calvert and Green Century and Trillium. Have any of you heard of any of those companies before? Maybe? Okay.
See that, some of them advertise.
All right. Yeah, probably in the Green America magazine.
Right. I was curious though also, what do you mean collaborate?
Okay, sure, we can talk more about that. So we build portfolios, and we use some of the funds that these companies put together in our mutual fund portfolios. We use some of the private money managers in our separate account managed programs. Yeah. So that's just an overview of who we are. We've always specialized in responsible investing. SRI goes by many names, socially responsible or sustainable and responsible, responsible, socially conscious, green, ethical, values-based, mission-based, natural investing, stewardship investing, impact investing. Has anybody heard the term ESG? This is one of the newer terms in our industry. ESG stands for the three main criteria that are used to screen the investments. What would you invest in or not invest in? You would screen them for environmental factors, such as, do these companies pollute? Do they only do what's required from a regulatory standpoint, or are they doing more than is required from a regulatory standpoint? Social factors, are they doing social good? Are they, companies that are treating their employees well? Are they doing business in repressive regimes? And that kind of thing. And then governance. How are the companies governed? So I don't know if any of you remember back in the 90s when Enron had their big scandal and they had all the accounting errors, and Enron stock just, they went bankrupt and all their bonds went to zero. And so corporate governance became a big issue at that point, and still is. So we've seen this recently with Wells Fargo and corporate governance. They made a whole bunch of fake accounts because they were incentivizing their employees in the wrong way. And so that's what governance means. So when I started in the industry in 1992, 25 years ago, SRI meant socially responsible investing. Now it means, at the very bottom, sustainable, responsible, and impact investing. Just kind of handy that those three words still work. But it really all means the same thing. People call it different things. It really all means the same thing. So regardless of the term, it's investment activity that's intended to generate both competitive financial and positive social returns. So go ahead. So we call it double bottom line investing because you get financial returns and you get social returns at the same time. So it's designed to take a long-term approach to shareholder value. Go ahead. All right, this is a really fun slide. You probably can't read a word because it's real small, but it's a timeline of SRI, basically. This is not new. SRI is not a new concept at all. Does anybody know, can anybody guess how SRI got started? If you can read it up there, you can see. Religious organizations. They didn't want their money to be invested in anything that violated their principles. Makes sense, right? There are still, to this day, many religious organizations that do not screen their investments. One of the big ones that still do, and it's actually mandated in their bylaws, is the Methodist Church. So for example, we work for the Methodist Church in La Mesa, and we do their portfolios. But back in the 1700s, the Quakers were one of the big movers of investing their money in a way that was aligned with the value system. Can anybody guess when the very first mutual fund started that had some kind of social screening? I don't even know if this is on here. I don't see it on here. Does anybody want to guess? 1938. It was called the Pioneer Fund. And they screened out alcohol, tobacco, and gambling, the sin stocks. We don't consider that, and by the way, that fund is still around, and it's had a very good long track record. But we don't consider it an SRI fund today because they never added any more screens. They never added environmental screens or corporate governance screens or anything like that. But in fact, that was the very first mutual fund that screened. When I came into the industry, which was 1992, the industry was just rebounding from apartheid in Africa. And Calvert, which I mentioned earlier, was the very first mutual fund that divested every single stock from every company that was doing any business in South Africa due to apartheid. So they set a precedent there, and when apartheid ended, they actually opened a fund called the Africa Fund to try to reinvigorate South Africa and bring in jobs and things like that. It was a great concept, but that fund didn't make money, and they couldn't keep enough money in it. People pulled their money out because it didn't make money. So they don't have that fund anymore. But for a little while, for a few years, they had a South Africa fund. So Calvert is one of the very early adopters of screening, and they're still around. They recently got bought by Eaton Vance, just in case anybody's interested. So there's consolidation going on even in our industry. And so we had a big push when apartheid was going on to divest from South Africa, and when apartheid ended, the next big movement really was tobacco. And that was going on, that started when I was in the industry in the 90s with the American Medical Association. I don't know if this is on here, I'm just kind of going on. The American Medical Association said, hey, we want people, we want cities and pension funds and institutional investors to divest from tobacco stocks. And so there was a big push to divest from tobacco stocks. So I would say the very next big movement was with Enron and the accounting scandals and corporate accountability and corporate governance. We had that, and now we've got environment. And now, 1 in every $5 is invested with screens. 20%. I'm going to show that a little later, so go ahead, move on. So, the evolution of SRI. Weak governance standards contributed to the global financial crisis. So we had sin stocks, we have shareholder activism. I'm going to let Robert talk about shareholder activism a little bit later. Environment in the 70s, and South Africa, and product safety, workplace. These are some of the big issues that corporate scandals and financial crisis. So with banks and all of that. So when we talk about building portfolios, we look at the traditional typical investment process where you have investment managers that do financial research. Okay, is this company growing? Are they profitable? You know, what do they have in the pipeline? Do they pay dividends? You know, what's their track record? And they build their portfolios based on the financial and quantitative research. So we overlay, and this is the responsible investment process, we still do that, but we overlay the social criteria, or we call it the qualitative research. So we have always felt like, why wouldn't you do that? It just makes perfect sense. Wouldn't you want to be even more careful about which companies you choose? Wouldn't you also want to prevent, as much as you can, being involved in very expensive cleanup costs because you were dumping toxic waste? Wouldn't that be a huge liability? Wouldn't it be a huge liability if you weren't treating your employees well, right? Because they're going to sue you. So this qualitative research, this social research, this ESG research, or whatever you want to call it, we have always felt like it reduced the risk of the portfolio, and it made sense to give you a smarter and lower risk portfolio. So again, this basically says what I just said, that it integrates ESG factors and it considers the social environmental consequences within the context of the rigorous financial analysis. Again, it's a double bottom line. It's quantitative plus qualitative. You have the financial and the extra factors for building your portfolio. So it's more information, more data is better. So when I started in 1992, when there were maybe 8 mutual funds that were socially screened, and I actually have a slide on that later, we always thought this made perfect sense, but more and more research over the years is telling us that this growing body of evidence that companies that manage their environmental, social, and governance risk most effectively tend to deliver better risk-adjusted financial performance than their industry peers. Finally, right? It's finally been building, and there's a huge body of evidence now, and we've got some more, so keep going. So this is a cool slide because it kind of shows the cycle of what we feel companies should, part of the role we feel companies should play in society, that they shouldn't just be looking for this short-term thinking. This short-term thinking, this profits only, is very it's non-sustainable over time. And so if we can look at all these different factors, clean energy, healthy food, climate, eliminate waste, that over time you're really going to have better corporations because they're actually providing social good. I'll let you read this one.
We use that on our trifle.
Oh, have you seen this?
We have it on our
You
trifle.
do. Isn't it a great one? What if it's a hoax and we create a better world for nothing?
Darn it.
Darn it! It reminds me of a saying in our industry, just our financial industry. I tell people sometimes, I say, how much should I save for retirement? I say, well, you know what? First of all, let's see how much you can save. Save as much as you can, especially younger people. Save as much as you can. But it's not like when you get older, you're gonna go, oh, darn it, I saved too much money. Oh, darn it, I saved too much money. Anyway. So we've got a few myths we're gonna talk about. And you may know about these myths and didn't even realize you knew about these myths. The first one is, number one, I'm going to have to sacrifice performance on my portfolio if I want to be invested with my values. Has anybody ever heard that said or thought that themselves or anything? Raise your hand if you kind of heard that or thought that or...
Had a friend who mentioned it to you when you brought up the topic.
Yeah.
It's like
Anything.
most people have.
It's true.
Almost everybody.
It's true about every other aspect of society, so why would it be different with investing?
See? So, right, that's what people think. That's what a lot of people think. And when I started in this industry, I'm going to tell you, almost every single client of mine, and they're almost all still clients, unless they've passed away, told me, and back in the 90s, they said, Judy, I don't care. I know I'm going to make less money. But I just don't feel good if I'm investing in these companies that are, raping and pillaging the earth and doing bad things for society and their employees or whatever. So I said, well, I just don't think that's true. But we didn't have enough evidence. We have the evidence now. We have all the evidence. There are so many studies, it's ridiculous. There's an award given every year now at the SRI conference called the Moskowitz Award, and it's for the best quantitative study on responsible investing, and oftentimes it's given to a performance-based study. Not always, but it's proven now there is, number one, no difference in performance, and some of the newer studies are saying there's probably even a little bit of performance edge. In other words, better performance with sustainable portfolios. So I'm very happy to say that the evidence is out there, and this is truly a myth. So if anybody ever tells you SRI underperforms, you can tell them it doesn't, and you just email us and we'll send you links to all these studies because they're all out there. A lot of them are on the US SIF website.
I just wanted to add one thing on
Here.
that. An analogy to look at that's a lot of people can relate to is just look at your own house. Thinking about how you use energy in your own house, how you use water, how you have solar panels possibly on your house or a neighbor does. I've never heard of a neighbor of mine who got solar panels on their house and said, man, I'm paying more for my energy now. I wish I wouldn't have done that. There's always a savings. And it pays off over time. Of course, there's a investment that you have to pay up front to get the infrastructure, but over time, it pays off because you're saving on energy, you're cutting down your costs, you're finding a way to make an efficiency. So that's a good analogy that we like to use that a lot of people can relate to. It's another way to bring in a more holistic approach to another part of your life, just like your house.
Great. So we are here to say that our portfolios are performing right in line with the market. There is no sacrifice of performance. This is one of the newer, a couple years ago. Yeah, go back to that one because this one is newer, 2015. And it was actually done by Morgan Stanley. Nobody really thinks of Morgan Stanley as an SRI firm, but they now have a division. And like this beautiful lady over here asked, well, what about all these different advisors? Well, there's a lot of SRI advisors now because the truth is out. It doesn't underperform, and number one, and people are demanding it. People are asking for it, yay. So the key findings of this study was that there's a positive relationship between corporate investment in sustainability and stock price and operational performance based on a review of all the existing studies and long-term annual returns of One index comprising firms scoring highly on environmental, social, and governance criteria exceeded the S&P by 45 basis points. That's almost 0.5% since inception in 1990, and I'm going to show you a graph of that. And sustainable equity mutual funds had equal or higher median returns and equal or lower volatility than traditional funds. So we're super excited about the Morgan Stanley study. So this is the graph that they refer to in there. This on the green line is the KLD 400 social index. So it's a version of kind of the S&P 500, but they took out all the bad guys, all the polluters and all the bad companies, and they filled in to make equal weighting in the right industries, some other companies. And they've tracked it since 1990. And this index has outperformed the S&P 500. Not by a lot, but the whole goal was just to see if SRI underperformed, like everybody used to say it did. And it never has. It never has. So how many years is that? Since 1990? 37 years? 27 years, excuse me, 27 years? Almost 30 years. So go ahead and go on. And that only went to 2013. So, oh, you can't see the other line. This one, for some reason, the light blue, you can't really see. This is the last, since 2006, the last 11 years. You can see the numbers on the top right, but the Domini index, oh, so this goes from before the last downturn to current. So that's current. And the Domini was up 89%, and the S&P was up 85%. So how about that? And these are just the studies. If you wanted to find them, there's some links there. We can definitely send you those links. Okay, so I think I'm going to let Robert talk about this stuff. Robert's got a degree in environmental studies and really loves the social aspect of what we do. So I'm going to let you talk about, and I'll move the slides, about some of the social stuff.
Great. So in Judy's prior slides, she mentioned shareholder activism, and I just want to briefly explain that before I explain this slide, or else I won't quite have the context. So shareholder activism is become, it's evolved in the past decade or so. It's become a very powerful way to make an impact with your money. So the idea is that since you're a shareholder in any company, or if you own mutual fund shares, you own sort of small shares of other companies, you essentially have a voice. You are a shareholder. You could attend a board meeting, and raise your hand and say, I don't like what you guys are doing, I'd like to see something done about it. So that's the simple concept of shareholder activism. SRI, before that, was more passive in that they would apply screens, negative screens or positive screens, but they wouldn't engage with the companies. In that, we feel is a wonderful progression that's allowed a lot of impact to be made. So, the differences are made when you can go into the companies, and here's some examples of some of the areas that they talk to them about. A huge one that we've seen in the past few years is sustainability reporting. For instance, demanding that a certain company like Starbucks produces a yearly report on sustainability metrics, how much water is used, what their sustainability of their growing their coffee, how their social treatment of the workers on their plants, just getting the information out there so people can then make decisions on that. So with these reports being demanded, it's allowed the mutual fund companies to make decisions that are much more informed, much more thorough. And a quick fact on the reporting, this has been a huge area. About 5 years ago, only 20% of S&P 500 companies produce reports. Now it's 80%. So it's a huge sea change. The companies are realizing that it's important to people to get these reports, that it matters to them. and they don't want to be behind the curve. They want to be competitive, they want to be respected, they want their brand to stand up, so it's important. They've responded really well to this. Could you just go back? I just wanted to touch on some of the other ones. So some of the other big topics have been diversity in the workplace, more inclusion of women. That would be in the G part of ESG, in the governance portion. There's been a lot of evidence showing that greater female inclusion in companies leads to better performance and better management throughout the chain. So that's been a big push. Environmental related shareholder resolutions have been huge, requiring that companies reduce their carbon footprint or reduce the valuation that they have on oil, and so on and so forth down the chain with water, loan servicing policy, requiring that people that provide loans have a better screening process so they're not just giving out loans to more offensive projects like the pipeline project and Pipeline Excel. I'll get to that in a little bit. So you can go to the next slide. Some big victories in the shareholder resolution world. And again, these are called shareholder resolutions, and how they work from a practical standpoint is if you're an investor, let's say you own some shares of General Mills, you have to own shares for about 2 years, and you have to own about $2,000 worth of shares. You don't necessarily have to be the one to go into the boardroom. There are organizations who will contact, our clients have been contacted before with our permission because they've owned shares and are eligible, and they're basically the foot into the door of the companies. So you authorize your shares, and from there a company will speak on your behalf to try and make advances. So some big ones that you could see at the local supermarket is Cheerios. Cheerios is now GMO-free. They make a GMO-free version. I think there still is a non-GMO one. I think they're pushing to get it pure GMO-free. And this was all precipitated by shareholder resolutions. This was all pushed by these organizations who are trying to make corporations be more responsible. Another really big one, has anybody heard of this one on the bottom, the Pebble Mine Project and the Bristol Bay Fishery and protecting that fishery? Good. I'm glad you guys have heard of it.
I thought it was still alive.
The fishery or the mine?
The mine.
The mine is, it's a zombie type of alive. It's still around kicking, but it's not really active. And I'm going to speak on this especially because I have a very personal stake in this resolution. In the summers, I'm a fisherman in Bristol Bay. I've been fishing there for 8 years, and it's something that I really love. I love the lifestyle. I love being out in nature and having something that connects me with the earth. So yeah, I was talking to her about boats earlier, and now she gets it probably. So I've been doing that for, like I said, for 8 years. I've started to work with Blue Summit after that, and to me it was I asked myself a lot, what difference does this industry make? You know, I'm a natural skeptic. I feel everyone should be to some extent. So I was curious what impact this industry made on the world. And when I heard that my fishery that I'm proud to be a part of was being supported by this world of socially responsible investing, that kind of hit home for me. So I'll tell you a little bit about how this resolution has worked. It was organized by multiple people that we collaborate with, and they essentially asked who cares about this fishery. So it's the fishermen, the native population, the companies that get this fish, Costco, Trader Joe's, Target, and the people who buy this fish. So who are all the people that would be affected if this fishery was destroyed? They then, after identifying them, they gathered all the voices, brought them together, and found different shares, found people who had shares possibly in the mining companies, or without the shares. They approached the mining companies and they said, look, this cannot happen. They helped fund sort of resistance groups. They help fund the EPA Clean Water Act that helped protect the fisheries. So once they identified all the stakeholders, they got them involved and hit the whole project from multiple angles. And it's been successful. Like you said, it's not dead. The project is still alive. I feel like it's on the way out. They're just hanging on. So it's still a fight that needs to be engaged in, but they're certainly not gaining on us. So this is the next myth, is that SRI is just a fad. It's a fringe thing. It won't catch on. It's just here for a few weeks, and a better thing will come up after that. That's not been the case. You can see by the amount of money that's been invested in socially responsible fashions, especially since 2010. That's almost $3 trillion in 2010. Fast forward 6 years and you're at $9 trillion. So it's rampant, the growth of SRI. I believe the reason this is people are realizing that it is competitive financially, and people can also feel more connected with their money, more aligned with it, feel more proud about what it's doing, instead of. And in this age of social consciousness, of people caring about what they do, about what they eat, about what they buy, about what their money and their life supports, it really fits the direction of a more sustainable world, to also have your money doing what you would do with what you want your life to symbolize as well. So, next slide.
You might enjoy the number of funds that we have now compared to the
Mm.
90s.
That was hard to read. It's
Yeah.
probably harder for you guys to read, but again, starting from 2010, there were about 500 mutual fund companies, who used ESG factors in their analysis of building their funds. Fast forward 2016, it's a little outdated still, but over 1,000. So a lot more funds are catching on to the idea that incorporating ESG criteria into their funds is a smart idea. It makes sense financially, it reflects well on the company's reputation. So it's not just a fad. Again, this is more graphs showing the growth in sustainable investing. And on the bottom, it sort of comes back to the shareholder resolutions and talks about some of the themes that are prevalent. A big one is pressuring companies to be more forthright about their political spending and their lobbying. That's something that people have been demanding more, and that companies realize people do care about. And another thing on just corporate power in the world, corporations now are more powerful collectively than any governmental group, any country, any nation. So talk about affecting change with the big fish. And these companies have a huge impact. They have thousands and thousands of workers. A company like Coca-Cola is in almost every country in the world. I probably can't name a country that they're not in, maybe Cyprus, but they're probably there too. So it's a really big impact to get into the companies and demand for change, environmentally, socially, and internally to their governance. So this myth is busted. It's a burgeoning industry, and it's not going anywhere. Either way. So, again, going back to what Judy said when she started, there's been a lot of current events can play into socially responsible investing. Apartheid in the 90s was something that people rallied around and realized that they could affect the course of that event through finance. A lot of times money is the wind in the sails to any movement, both good and bad. So if you take money away from a bad movement, you're starving it from the fuel that it needs to keep going. And If you put it into a more positive movement, you're giving that movement what it needs to keep going. One that we've been working with a lot with our clients, and as you mentioned, was fossil fuel free investing. The divestment push from fossil fuel free has been huge since 2013. It started earlier than that, but the sort of critical mass started when a lot of colleges and universities in America and internationally were requiring that their endowments would pull the money out of fossil fuels. It's very risky. Shell and BP and Exxon has a lot of money in their valuation that's tied up in barrels of oil. What happens if you can't burn those barrels of oil due to regulations from governments or international organizations? What happens to the valuation of that company? And then what happens if you own millions or billions of dollars of shares? You stand to lose a lot. So there's that aspect. There's the ethics aspect of supporting a company that doesn't, it's contributing to climate change. So that's been a big push, is pulling money away from fossil fuels. And that's something that we've worked on in the past 3 years, is to create a fossil fuel free portfolio that we can provide to our clients, that they can feel comfortable investing their money and not support any aspect of fossil fuels. So from the whole chain, from exploration to production, to transportation, to refining, to end usage, none of that is included in a fossil fuel free portfolio. We've been really happy to be able to provide that to our clients, and we've seen that as a burgeoning interest from our clients.
You want to explain to them which one?
Yeah, so these are our 6 different portfolios that we offer. They go, the red portion is probably the easiest to see. That's the bond percentage. So the most conservative portfolio we offer is about 60% bonds, 40% stocks, and it ratchets up from there, about 50-50, and then 40-60, so on and so forth, to the most aggressive, most stock-heavy portfolio on the bottom right. Our fossil fuel-free model is only offered in the bottom left portfolio, which is our balanced growth, which is a 70-30 stock bond. The reason that we chose that to offer as our fossil fuel-free model was that was our most popular model. Most of our clients scored into that allocation, so we figured it was the most utilitarian to offer that model is fossil fuel-free. There's some technical complications of offering it in the other allocations, so we wanted to make it in the model that fit most people.
We actually, and you don't know this, but I put together a picture of our actual fossil fuel-free portfolio showing the last year performance. So we can look at that when we're done with the slides,
Okay.
if they want to.
Yeah, these slides are quite a surprise to me. I'm not sure what's next. So.
A disclosure.
Oh, a disclosure on securities. Of course, we have to include this.
We wouldn't be financial advisors if we didn't include a disclosure.
Mm-hmm. So I'll let these beautiful, eloquent, poetic words sink in about no guarantees, no fixed rates of returns and market changes. So
that's the end of our slide presentation. So I also have on the flash drive the Morningstar of our fossil fuel free and actual performance showing of our portfolio. So if you know how to navigate back to the other things that are on flash drive,
yeah.
I can start talking about some of the other things that people wanted to address and start taking some questions.
Okay, that sounds good.
All right.
I wanted to adjust the Wells Fargo thing, but I think I'll have a little slot for that. So yeah, we'll swap.
All right, any questions, first of all, about all of that? Yes?
I would just like to ask you to either summarize again or re-clarify what Robert was saying about the packages and the one about the proportion that's fossil fuels.
Oh, the 6 models. So those are our 6 portfolio models based on risk. So as financial advisors, we can't just, let's say you have, $100,000 to invest. We can't just say, okay, we're going to invest it all in stocks. That might be too risky. You might want some bonds like this gentleman here. He loves bonds. He already told me that, right?
No, I didn't say that.
You wanted us
When
to
they're
talk
good,
about bonds.
When they're good. When they're good, I love them.
Okay. He loves good bonds. So we don't know. So we do a whole risk profile before we'll actually invest your money. And depending upon how you score and depending upon what we learn about your cash flow and what you might need there, because you know, I'm a CFP first, you know, and then the SRI comes in after we design the right portfolios. So we first have to get you in the right risk profile. So that's what those were. They're different allocations based on risk. And so all of our portfolios are socially screened, our SRI portfolios, all 6 of them. But we found that even with all of the funds that screen, they screen for so many different things that not all of them were 100% free of any fossil fuel exposure. They might have had like a transportation. Now none of them have like drilling companies, but they still might have had some exposure. We found that there was about 3 to 4% exposure to fossil fuels. So we decided, and we have many clients who were asking for completely fossil fuel free. So we picked our most popular model, this balanced growth model down the bottom left, which is about 70-30 stock to bonds. And our analyst went through and built a portfolio. We had to get rid of a few of the funds that wouldn't work, and we had to add in some other funds. And we, for the last, I think it's almost 3 years, I think in March it'll be 3 years, have had a completely 100% fossil fuel free portfolio. And every quarter he goes through and looks at all the holdings to make sure nothing is creeped in that has fossil fuel exposure. And we're going to show you a picture of that portfolio and how it's performed in the last year. So, does that answer your question?
Yeah, it does. Thank you.
Okay, you're welcome. Yes, question.
Okay, how many of your portfolios have foreign companies in them?
Well,
Or have foreign ties?
these all do. You're going to see that there's a yellow portion. I believe it's the yellow portion that's international. So we believe that in order to have the lowest risk with the highest possible return, that you need to have a diversified portfolio, even if you're all stock. So even our all stock portfolio, and for some reason I can't see the bottom, which has the key.
It's a light green that's international.
So it might be the light green. So if you can scroll it up or something. So even our all stock portfolio, there we go. It's green, sorry. It has 47%. The largest percent is large cap US. The 25% in yellow is small and mid cap US. But the light green is the international. So every one of these has a percentage in international, because how are you going to know what year is going to be the good year for international? You don't want to not be an international. So we don't try to time the market. We allocate. It's called strategic allocation. So does that answer your question?
Yeah, but do you have a fund that doesn't have international?
We have income portfolios for income clients that aren't related to these 6 portfolio asset allocations that are designed more for income, and then we don't invest in international.
Okay, but how many of the companies that you do have in these portfolios have foreign ties?
So, you know, even with U.S. companies, if they're large cap, that 47% in large cap, they're going to be almost all your large cap U.S. companies are really multinationals anyway. There is almost no large cap U.S. company that doesn't do some business internationally. Do you have a specific reason for asking this question?
Yes, because I'm a former union man.
Okay.
And I'd rather have American jobs here in the United States.
Mm-hmm.
So all these businesses are moving overseas because of cheap labor.
Yeah.
And that's not right. I don't think that's right. It's
Yeah.
not good for our economy, not good for the middle class.
I agree with you, and that would be a great idea for putting a portfolio together. But we don't have a fund that's put together solely on that criteria. That would be, let me tell you a little story. Remember I mentioned there's an award given every year for research. Well, one year, this Wharton business school professor won the award. And the research that he did was based on the 100 best companies to work for in, I think it's Time magazine. I can't remember what magazine, but they publish the 100 best companies to work for every year. And it changes, every year a little bit. So he went through back to the beginning when they first started it, and he put together a back test, a hypothetical portfolio of all the companies that were on that list, the 100 companies, and every year he changed it and he did this back test. And this back test way outperformed the S&P 500. So that's an example of putting a portfolio together just based on one criteria. But that criteria there might be some companies in there that were polluters. We don't know, just because they treated their employees well. So another example of like a single criteria portfolio is PAX. We mentioned the PAX fund company. They opened a fund based on women, and it was a women's equity fund. And they were selecting companies based on how they treated their women. Did they give them good benefits? Did they have women on the board? Did they have women in upper management? Did they promote the women? They felt like women in the workplace were really beneficial for corporate success. And we looked at the portfolio and we couldn't invest in it because they had too much fossil fuels. And they had some tobacco. So I think it's a great idea to do a portfolio just based on not employing any foreign labor. But I haven't seen that done yet. So kudos to you.
Maybe it's something you could work on.
Maybe it's something we could work on.
Yeah.
Maybe you gotta come to our office and help do some research for us. Thank you for that question. Yeah. Any other questions? And we've got a couple other things we want to show you as well. But any other things? And you asked me about bonds. We do bond portfolios. So we do mostly muni bond portfolios for our income-oriented clients, or when we've got a large amount of assets, we might do all equity in our equity portfolio and then just do an all bond portfolio where we're selecting all sustainable and responsible bonds. So we'll look for bonds that are doing solar, we'll look for bonds that are doing water treatment. There's all sorts of green bonds out there now. So yes, we do a lot of green bonds. They don't fit into those 6 models. They're just straight bond portfolios. So happy to talk to you about.
Now, do bonds do better when the market is low, and they don't do as good when the market goes high?
Bonds are more impacted from interest rates, not necessarily the stock market. And it depends what type of bond. So if you're talking about investment grade bonds, they're going to fluctuate more with interest rates, and they fluctuate inversely with interest rates. If you're talking about more high yield bonds, those are going to fluctuate more with the market because they're your higher risk bonds. And if the market's doing well, then people figure the bonds will hold up, they won't default. So it depends what type of bonds. Do you have any particular type of bonds you enjoy investing in?
I would say green bonds, something green.
Yeah.
And that has ties only in the United States.
Yeah, so most of our clients that we have bond portfolios for, we're doing California muni bonds because they're double tax free here in California, if they're California clients. If they're in another state, we'll do them in their state. And we're looking mostly for investment grade bonds that have an impact, so green bonds. So yeah, we do
I
quite.
have some California bonds. I like California.
Yeah, and I like California bonds as well. Yeah, and I personally manage all the bond portfolios, so we have an analyst, he does the other portfolios, and eventually I'll turn the bond portfolios over to him as well. He's not with us tonight, but I also want to extend an invitation to any of you out or here tonight to join us at our holiday party next Tuesday. If you're interested, come. Do you want to pass out the handouts while I'm taking some questions?
I already passed out the handout.
Oh, you already did. So take our card and shoot us an email that you'd like to come. It's next Tuesday. It's downtown at 7:30. So we are having a holiday party for our clients, and we'd like
Is
to.
that downtown Fallbrook?
No, it's downtown San Diego. Yeah. Sorry about that. So this, what we have up. Any other questions? And I've got a couple other quick things to show you. This is the Morningstar report of our fossil fuel-free portfolio, just to show you a little bit. It's very detailed. It's got a lot of pages. We're not going to go through it all. You don't need to understand it all, but just because people here are very interested in climate change and the fossil fuel divestment, this is, I'm going to walk right from it. This is, no, here we go. This shows a back test of the portfolio from 2013, so for the last 4 years. And we can see over here, it's averaged 8.24% return for a cumulative return of 36%. This shows the different funds that we buy in this portfolio. There they are. There's a list. So we have Parnassus, we have T. Rowe Price, we have Amana, American Century, we have Calvert Green Bond, Pax Global, Portfolio 21 Green Century. So we always have between 10 and 12 funds in our portfolio to be well diversified, and it's our analyst's job to go through every quarter and analyze the funds and select the funds and switch them out if they're not performing well. And this shows, and by the way, this is only through the end of September. So down here is where you can see the 1 year performance, 12.8, and the 3 year 7.7. And this shows the allocation. Sorry, I don't have a pointer. I guess the pointer ran out of battery. So there's a lot more analysis on here that we don't really want to spend time on. How can we bring up the other document? Can you bring up the other document? This one. That one right there. Not the first one. All right, so what we did with this next document, oh boy, it's small. Can you make it bigger? Is we actually are showing you one of our clients' accounts with the name redacted. There we go, much better. Can you scroll down? So you can see all the funds. This is a diversified equity portfolio. And you can see all of the funds that we have bought in this client's account. You can see a year ago, it was worth $185,000, and now it's worth $206,000. It's up 16.6% in the last year. And that's our diversified equity portfolio. And then the next one is our fossil fuel free, which is 70-30. Remember, it's got 30% bonds. And when the stocks are up, this isn't going to perform as well as a 100% stock portfolio, but it was up 14.55%. And if you scroll up just a tiny bit, back up a tiny bit, it's kind of hard. You can see that's our fossil fuel-free portfolio. You want to go back down a little bit so we can see that?
Oh, that's
All right, there we go. It says fossil fuel-free. That's our fossil fuel-free portfolio.
Oh, jeez.
So,
Zoom out.
technical difficulties. Any questions about that? There was one thing I didn't get to. You asked about different financial advisors. You have got asked a question we haven't yet spoken about, and that is, what's the difference with different financial advisors? So that's kind of a big question. We at Blue Summit take a very holistic approach with our clients. When clients come in, we take a look at their whole entire financial picture. I'm a CFP, our analyst is a CFP, Robert is starting to work on his CFP. And so we feel like the planning work is first, and then the investments come out of the planning work, because we don't feel comfortable making investments until we know what you really need. So we start with the planning work, and we do a financial plan, and then we make investment recommendations, and then we implement them. Not all advisors do planning work. So that's one difference. Another difference might be how they charge their fees. So we are a fee-based firm. That means we don't work on commission. So we charge a fee to manage the portfolios, and we charge a fee for our financial planning, but we don't charge commission. So that's another difference. The other difference is, you know, some advisors are just not as good looking as we are. Just kidding. You know, who you connect with, it's very important if you're choosing a financial advisor that you feel that they care about you. You know, they care about your financial well-being. So I have been on the board of the local financial planning association, and you know, different advisors have a little different approach sometimes on how they work with their clients. But other than that, does that answer your question?
Yeah.
Okay.
One quick thing I wanted to add too, about the SRI portion and what might differentiate us from another advisory firm is, when we create these portfolios here, we are choosing each one of these underlying funds. We're doing the analysis on that. We're doing that in-house to decide on who we pick, sort of who we put at each position of the team. A lot of other advisory firms who are SRI, they farm that portion out. They say, we'll get your money working towards SRI goals through SRI funds, but we don't do that selection. So that's something that we feel brings more quality and more care into the process, is that we have, that's the sole job of our analyst, Alan. He, you know, out of these, it looks simple, you know, there's 14 of those funds, but that was selected down from a universe of thousands of, you know, SRI eligible funds. And we found the best ones that perform the best, are the most engaged with the companies that they own, that are the least volatile, things like that. So we feel that brings another level of quality into the process. Any other questions? I know the Wells Fargo thing, I'm going to address that quickly. And we have a living example. This fund here, the Parnassus Endeavor Fund, they were the fund that Judy was talking about that focuses on quality workplaces. They actually hold Wells Fargo, and they've been pressed about that, especially since the DAPL, this time last year when DAPL was really big on current events. They were pressed by Parnassus and other shareholders. Parnassus organized a lot of other shareholders who held shares of Wells Fargo, and they pressured them to build more stringency into their loan process to try and prevent, build more human rights into the screening of who they give their loans out to, since you know, the DAPL was obviously a big human rights violation. So they can't force the company to do something. The best thing they can do is to put pressure on them to bring it to their attention that this is going to reflect poorly on their company, and they amass different shareholders. They usually, how they sort of gauge that is they say we have $1 trillion worth of shareholders, or $500 billion worth of shareholders who are signatories on this letter to you guys wanting you to change. So that's the way that they can put pressure on specific companies like Wells Fargo. So I think we're getting close to the end of our time. We might be right at the end or even over. So any last questions? I want to make sure that anyone has a chance to ask anything that's pressing. If not, you can ask us in private when we're done. But I think we should adjourn the meeting, and thank you guys for listening. We're glad we were able to present to you, and thank you, Bill.